moving average stochastic system, and here are the rules. The trend is up if the market closes above the moving average. The trend is down if the market closes below the moving average. To go long, stochastic needs to go above 80% and then come below 60% before crossover occurs. Here's what we mean. Here's your 80% line. Here's your 20% line. Here's your 60% line. And here's your 40% line. Okay. What the stochastic has to do is it needs to go up above 80 and then come below 60 before faster stochastic crosses it. What this does is two things. By going above 80, it tells us the trend is fairly strong. And then when we look for a small pullback and then there's a crossover, we entering the trade with the trend. Profit target is based on volatility measured by 10-day average true range as explained in the money management videotape and manual. Protected stop is based on volatility measured by 10-day average true range. By using the 80-day moving average, it tells us the long-term trend is up. And then in this chart we are using 9-bar stochastics crossover. And what we're doing here, this line up here represents the 80%, and this line here represents the 60% stochastics. So right here, the moving average tells us the trend is up because the prices are above the moving average. Here, the market goes above the 80%. That tells us there's a momentum to the upside. Then we wait for a correction, and when the stochastics cross over, we have a buy signal. Here's another situation. We have gone above the 80%, and then market corrects below the 60%. That tells us we have a correction, and when the market rallies, the stochastics crosses over and gives us a buy signal. And right here, the same thing again. We have a strong trend. Stochastics is above 80. Market pulls back. There's a correction. It goes below 60%. And when the stochastics cross over, we get a buy signal at the close, and the market continues to go up, then enters a sideways pattern. The purpose behind these exercises is to teach you the importance of understanding the relationship between trend waves and the correction waves, sideways pattern, and how critical it is to trade with the trend. In this first trade here, we have a strong uptrend. The stochastics goes above 80%. During the correction, it drops below 60%, and then we have a crossover, and market initially goes in our favor. Then it starts to go against us and sideways. Most likely this trade would have been a losing trade, but look what happens when market entered the sideways pattern. The market after this trade did not reach 80% again, and therefore during this rally we did not have a setup because we need to first go over 80% and then come down below 60%. You can see after this entry the market did not go above 80% again, and therefore we avoided a losing trade here, and during the sideways market we only had one losing trade, and we were able to avoid two losing trades. Now, this is a 20-day moving average. What the 20-day moving average does is it trades only the small corrections because the 20-day moving average is a very short-term trend indicator. And what happens is when there's a big correction, it thinks that this A, B, C pattern to be a trend reversal. The 80-day moving average would go down this way, and it will tell you the trend is still up. But the shorter term moving average of 20 days, when you have a big correction with an A, B, C pattern, it thinks the trend has reversed, and it will give you a sell signal. Here's a question. At any given point that you enter this market or any market, what are the odds that the market will go up $500 before going down $500, or what are the odds that it will go up $1,500 before going down $1,500? We're going to answer that question in a moment by giving you some long-term test results. Here we have a buy signal because here the trend is up. The stochastics goes above the 80%. This line represents the 80%. And then it goes below 60%, which is right down here. This line is 50%. Right here was 60%. The market goes below 60, crosses over, and gives us a buy signal right here. And then the 20-day moving average tells us the trend is down because the price is closed below the 20 days. And now the market has gone below the 20% line. And then if it rallies above 40%, which it did, and then we have a stochastics crossover, it gives us a sell signal. Because the stop was only 1 ATR, as soon as the market rallied a bit, we got stopped out. And we're going to be talking about whether it's better to use tight stops or wider stops. We will give you some test results so you can see what to do. Subsequently, market continues to go down. The stochastics goes below the 20%. And then when it rallies above the 40%, we have a setup. During the crossover right here, we have a sell signal. And then we take a little profit here. Here's one of the other reasons we want the 80%, market to go above 80 and then come below 60, or to go below 20 and then go above 40 before we trade. Here, the 20-day moving average enters into a sideways market. You can see market goes above it, below it, above it, below it, above it. But during that time, we have not taken any trades except the one here. The reason is, each time the market reverses its trend, the stochastics has to reset. In other words, here we are in a downtrend. We had a sell signal right here. And then what happened is that the market went above the moving average, telling us the trend is up. At that point, you need to wait for market to retrace and go below 60% and then cross over to give us a buy signal. But because there's not enough momentum to the upside, by the time stochastics goes below 60%, what happens is the market is below the moving average again. Now it tells us the trend is down, so now it has to reset. So during this sideways market, the very fact that we wait for the market to rally above 80% and then correct down to 60% and then cross over avoids some of the choppy markets. So now what we have done is we have found a way to avoid some of this choppiness and save some money for you. During the steady trend, 20-day moving average will make excellent money because the market will stay above the 20-day moving average. You will have strong trend moves which will carry the stochastics above 80% and then it will dip below 60% and then you will have a buy signal. And then the trend is strong enough to carry it above 80% again. And you have your correction and another buy signal. Here's the advantage of 20-day moving average. It trades strong trends. It catches trend reversal quicker than the 80-day moving average. On the other hand, disadvantage is during a big correction, it will give trend reversal signals when in fact the trend is still up. That is to say, here's the moving average. You might end up having the trend's been up. You might end up having a correction while the trend is still really up. If there is a B, C swing, it's going to give you a which most likely will not work. But on the other hand, if the trend had reversed, the 20-day moving average would have caught the trend reversal much faster than an 80-day moving average. So there's advantages and disadvantages of both methods. This chart, we're going to compare how the stochastics method behaves around 80-day and 20-day moving average. Here, the 20-day moving average would not have given us a buy signal because it had closed below the moving average signal, whereas the 80-day moving average gave us a buy signal and it was profitable. Here we have a big correction. The 20-day would have told us the trend is down, but the 80-day tells us the trend is up, and therefore we have a buy signal right here. These trades were generated based on 80-day moving average rather than the 20-day. So that's the advantage of using the 80-day moving average. It allows you to buy on intermediate to big size corrections, and it keeps you with the longer term trend. We have the sideways market. The 80-day moving average was the active trend indicator, and here we had a sell signal which lost money because of a tight stop. Then we had another sell signal which lost money because of a tight stop, and gave us another sell signal and we lost money again. Whereas the 20-day moving average during a sideways market like this keeps resetting the trend to the up, down, up, and the stochastics has to reset. Therefore, it would have avoided 2 of these losing trades out of the 3. And that's the advantage of the short-term moving average. In this chart here, because the 80-day moving average traded these big corrections and it made profit, it did better than the 20-day moving average because 20-day moving average thought the market was sideways, and therefore it would not have taken these winners. So again, there are advantages and disadvantages to both ways of trading, long-term and short-term. One time that the long-term moving average does poorly is during big corrections that result in a trend reversal, because the 80-day moving average thinks the trend is up and it's giving you a buy signal, but then you lose and then gives you another buy signal and you lose again. So that's one of the disadvantages of 80-day moving average. This is the same chart as the previous chart we looked at, where the 80-day moving average was active and it gave us a sell signal here, a sell signal here, and a sell signal here, and we lost money. Whereas the 20-day moving average lost money only once. During a strong trend, both 20-day and the 80-day moving average will do really well, but during sideways market, depending on the size of the sideways market, either the 20-day or 80-day will do better. Let's skip this chart here. Okay, another way of using stochastics, we have covered this, is as an overbought, oversold indicator. In other words, instead of waiting it for only to come down to 60% and then crossing over and giving us a buy signal, you wait for it to come all the way down below 25% or 20% and then cross over. What that does is it avoids some of these smaller size corrections, which are some of the more profitable trades. So the question is it more advantageous to wait for stochastics to go only below 60% and then cross over, or is it better to wait for oversold condition and then buy? And the test results are going to tell us in a moment which way of trading is the best. Here's one advantage of trading oversold. When we have an A, B, C pattern here, what happened is that the oversold indicator, in other words, waiting for market to drop below 25% on the downside, avoided a buy signal right here had we used this crossover right here. But by waiting lower, we end up getting in. We avoided this loss at the trend after the A, B, C swing. This is a table that compares the moving average stochastic system, comparing various parameters using 20-day moving average and 7 and 9-day stochastic. The question is it better to enter sooner or later into the market? Here's what we mean. The market does its correction, and then the uptrend is about to continue. The 7-day stochastics crossover, it's going to get you in about here, whereas the 14-day stochastics crossover is going to get you in here. 9-day stochastics crossover is going to get you in approximately here. So the question becomes, which one is better? Is it better to wait until the trend reestablishes and you get in a little later? Or is it better to get in as early as possible by using 7-day stochastic. And here's our test results. Here we use 7-day stochastics. Profit target was 3 times the average true range. ATR means average true range. And our stop was 1 ATR. Our profit target was 3 times bigger than our stop. And here's the net results based on 10 markets trading for 10 years. 7-day stochastic had $70,000 profit. 9-bar stochastic had $40,000 profit. Here the average true range, the profit, and the stop was the same. Again, the 7-day stochastic made $27,000. 9-bar stochastic made only $11,000. Here we have a profit target of 4 times the average true range and a stop of 4 times the average true range. 7-bar stochastic, 9-bar stochastic, 7-bar stochastic made almost 4 times more money. And here's some other parameters. These are the profit targets in average true range, and here are the stops for the 7-day stochastics. As you can see, this test proves to us that it is better to get in early during the correction phase rather than later. Now, we also answer another question, by the way. Remember, the question was asked, if you take a trading signal, let's say this red line represents the trading signal, and here's our profit target of $500, and here's our stop of $500. Which one will the market reach first if you are going with the trend, and how often will it reach $500 profit target versus a $500 loss? Here we have even number, profit target, and stop, and the accuracy was only 51%. So even when you go with the trend, you only gain a slight advantage. And here we have a even number for profit target and stop, and we have 56% accuracy. So clearly, going with the trend, you have a better edge than if you were going against the trend. Here we use 80-day moving average, and we compared 7-bar stochastics with 14-bar stochastic using different profit parameters and stop parameters. And again, the 7-bar stochastic had $59,000 profit, 14-bar had only $15,000. Here the 7-bar stochastic had $17,000 profit, whereas the 14-bar lost money. This tells us the later that you enter after the correction phase, the less money you're going to make. And the sooner you enter, the more money you're going to make. This test here, the 75-25% represents when the market is oversold. That is to say, that's when the stochastics came all the way to the lower end of the trading range, and when it went all the way up to the higher end of the trading range and then crossed over. If you compare the results of the 80-day moving average, where this is the result based on 60% correction, and this is based on market going all the way down to 25% before you take a buy signal. To make sure I make myself clear here, here's the 100%, here's the 0%. Stochastics is going up and down. Before we could use the crossover, we waited the market to go down to 25% and to go above 75%. And in the other case, we only waited for market to come down to 60% before crossing to the upside, rather than coming all the way down to the 25% line. On the buy side, one system waited stochastics to go above 75 and then cross over and give a sell signal. And the other one waited for market to go above 40% right here and then cross over and give us a sell signal. So here the parameter of 3 by 1 made $21,000. This is the 75-25% stochastic rule. Here we had the 60% and 40%, and it made $59,000 versus $21,000 here, $59,000. And if you compare all the different parameters in the long run, the earlier entry, that is only waiting for a market to drop down to 60 and then cross over, or if the trend is down, to rise to 40 and then cross over, better than waiting for oversold, overbought conditions. Okay, so we got rid of another myth. that you should wait for markets to be oversold, overbought before you trade. That is not true. What you want to do is go with the trend. Here, what we did is 80 and 20 together. In other words, the market, here's your long-term 80-day moving average, and here's your shorter-term 20-day moving average. And the price had to be above both of them. That is, the close had to be above both of them to get a buy signal, and price had to be below both of them to get a sell signal. In other words, we took into consideration the short-term trend as well as the long-term trend, and let's see if the profit results improved. Here we have 7-day stochastics, 80-day moving average. Here we use 80 and 20. Here's the parameter 3 by 1, 3 by 1, and it's hard to see unless you look at on your manual. This is page 61 and the other one is page 63. So here we made $59,000 profit. The dual moving average made $85,000 in profit. Let's look at another parameter here. 2 by 2 made $38,000, whereas 2 by 2 here made only $17,000. So again, as you can see, taking into consideration the long-term and the short-term moving average did substantially better. Now, there are several considerations when comparing test results. For easy comparison of results, the most important factor is the ratio of drawdown to net profit. Over here in this column, we have drawdown. This is the average drawdown for all the 10 markets that we were trading for 10 years. So what we do is we take the net profit and we divide it by the average drawdown, and that gives us the efficiency factor. In this case, the efficiency factor is 4.6. This is on your page 61. And that tells us how efficient the trading is, because the bigger drawdown, the more capital is needed to survive and to earn the net profit. On the other hand, if a system results in smaller drawdown but also much less profit, it may not be as efficient. The efficiency formula is as follows: net profit divided by drawdown equals efficiency. The formula tells us how much we are making for the risk we take. So here, efficiency factor was only 1.4 with the 14-bar stochastic. With the 7-bar stochastic, using the same parameter, the efficiency factor was 4.6. This is going to be hard to see on your screen because to fit everything on one page, we had to do the writing very small. So if you go to your manual and follow us on page 65. 80-20 means dual moving average. 20-day is the 20-bar moving average, 80-day moving average. Since 7-day stochastic does better than 9-bar and 14-bar stochastics, that means the early entry does better. We only compared the early entry from here on. This is your profit targets in ATR. For those of you who don't know what the ATR is, let's say the market has these bars versus these bars here. The volatility of these bars are almost twice as much as this. We use 10 bars to calculate what the volatility is. And if the volatility is $500 per day, then 2 ATR profit target would mean our profit target is $1,000. And our protected stop is $500. Down here, we use 2 ATR as a stop. So that means if the volatility was $500, then our stop would be $1,000. As you can see, 80-20 did consistently better than 20-80 on all of the different parameters we tried. Not only that, on the average, the accuracy of 80-20 was higher than either 20-day moving average or 80-day moving average. The drawdowns were less, and the number of losing trades in a row was less. You're going to say, wait, this system, which avoids sometimes sideways market, had 8 or even 12 losing trades in a row, and that is correct. And we're gonna explore that in a moment as to how that happens. This is the number of trades, and this is the efficiency factor. Just by looking at the efficiency factor, the 80-20 had 9 as an efficiency factor. The 20-bar moving average had 7.6. 80-bar moving average did poorly. It had only 1.7. And consistently, the efficiency factor of dual moving average, the long-term perspective, and the short-term perspective did much better.